Once banks are holding more gold or central banks are holding more gold, it really does create a cushion for even where market volatility, which always comes up in any asset, might push gold down. And that's kind of what we've been seeing. That was the point of that 10-year piece, is that, you don't see gold really reacting that much to volatility. I mean, you see some percentage movements down here and there, but for the most part, it stayed pretty constant. And so that's why I think we're going to continue to see it creeping up to these levels. Demand's not going to stop. All of these extra rules and conversations we've been having from state level to continued purchasing by sovereigns, etc., to being a tier one liquid asset for banks as of July 1st. This is all going to move towards a 4,000 level for gold over 20 into 2026, I should say, somewhere in the end 25 beginning 26 arena, and up to 5,000 the following year.
While April marked the most extreme price volatility in the gold market in over 25 years, May was not far behind. Gold fluctuated within a $325 range throughout the month, representing a slight decline from April's substantial $540 swing. For perspective, the average monthly price movement since 2020 has been around $89, underscoring the turbulent nature of recent months. This heightened volatility reflects the broader economic and geopolitical uncertainty, making it increasingly difficult for investors to navigate shifting market conditions. The rapid and often contradictory shifts in U.S. policy have added to the market's unpredictability. One moment, easing tensions in global trade fuel optimism in equity markets. The next, rising threats rekindle gold's appeal as a safe haven asset. These erratic developments continue to steer institutional and individual investors toward precious metals. According to American economist and author Nomi Prins, gold is poised for strong gains in the coming years. She projects a gold price of $4,000 per ounce by 2026 and $5,000 by 2027, citing growing demand, policy changes, and regulatory pressures. Gold's status as a monetary asset with no counterparty risk remains central to its appeal, especially as global central banks continue to diversify away from the U.S. dollar. The move has been intensified by the Trump administration's unpredictable trade policies, which have further eroded confidence in dollar-denominated reserves. In this climate, central banks are expected to remain steady buyers of gold, driven by the desire to hedge against economic and geopolitical instability. Silver, though often overshadowed by gold, is also showing strong potential. Prins notes that while silver's gains have lagged, its industrial importance, particularly in infrastructure and clean energy sectors, could drive prices higher. If supported by gold's bullish momentum, silver could rise toward the $50 mark shortly. Supporting this outlook, the Silver Institute projects silver demand will reach approximately 1.15 billion ounces this year. Although slightly lower than last year's record, it remains historically strong, reflecting solid industrial demand even amid broader economic uncertainty. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
My take on silver relative to gold right now, and why that ratio is so high, is that gold has so much momentum behind it, and not just because of purchases, but because of all of these factors that we're discussing right now, because of its hedged to uncertainty, its hedged to inflation, its physicality, its use as a central bank currency, its acceptance as a tier one currency for reserves, its discussions among states and among sovereigns worldwide in terms of it being or needing to be a tender and a part of wealth portfolios, individual investors coming more into the asset and diversifying their portfolios, corporations diversifying their portfolios, money managers from Morgan Stanley to BlackRock suggesting more of an investment to their private wealth clients in gold. I mean, it's all gold all the time, right? So all of these reasons culminate in gold's story being far more prevalent and powerful right now than silver's. And so that representation of past relationships doesn't really take into account what I'll call gold momentum because of all these factors. Now, that being said, because silver can be, India, for example, used to have lots of silver relative to its gold portfolio back in the day and so forth. It's definitely a precious metal that can be used for some of those purposes. But again, without that momentum, it also has secondary uses, which are actually its primary uses of being an industrial metal. And I think this is where it's actually had some problems, because while all this trade uncertainty has been happening, while economic growth has been, to an extent, stagnating, depending on which quarter you're looking at, but certainly adjusted for inflation. Silver as basically an expansive type of asset in terms of industrial growth has not had the story attached to it to combat the gold story or to even compete with the gold story. There's a fundamental amount of infrastructure being redeveloped in the United States from a manufacturing standpoint, to an energy standpoint in terms of upgrading, and its uses as a conductor, as is copper, and it's certainly majorly used in solar and other things throughout the world, as well as a wealth asset. But again, not with that momentum and with that pushback that, well, what is happening to the economy? What are tariffs going to do to growth? And because of that, silver just hasn't had, as much of the tailwinds that gold has had. In fact, it's had to contend with those headwinds, and I think that's just what we're seeing in real time. But if we take all of that away and note that actually, so that economic growth might be slow, but infrastructure development is still moving forward, and energy transformation development is still moving forward, then silver should eventually get some of those tailwinds back, and we should see silver prices, start to hit back around the 50 levels, or get to the 50 levels, once we see the trade stuff abate a bit and continue to have these conversations about its relationship to gold. But that's what's happening. It just hasn't had the force. Well, what's happening is there's different distinctions in terms of what Basel III, which is basically sort of the regulation document for banks internationally, says with respect to gold. And what it is that in about classified not just as a tier one, but as something called a high quality liquid asset, or an HOLA asset, which means that it actually has more power in a bank portfolio, because the idea is it can be liquefied as a treasury bond, as a government bond, as cash immediately. So it has kind of a higher level tier one status, and that's what's coming around the corner. And what happens is, if that's something, it's already tier one for central banks. So if that happens throughout the banking system, what that means is more large banks are going to want to have more of their portfolios in gold rather than in debt, whether that's replacing debt with gold, or whether that's simply augmenting their gold position and augmenting their debt position less in the future. However that looks, what it will reflect is banks buying more gold, because gold is now considered not just a reserve asset, but a high quality liquid asset. And that actually is a major distinction that's coming around the corner with respect to all of these Basel conversations. And it's a really good question, because I think people don't necessarily, or haven't really necessarily thought about that distinction. But to me, it's a big difference. It's the kind of distinction that makes financial players throughout all sort of levels of the financial system, domestically, in the U.S. and globally in general, want to buy more gold. According to the BIS, if you have gold in your portfolio already, it has something called a 0% risk weighting. So already, if banks had been holding gold, it doesn't count negatively towards their risk profiles, which is a positive, like if they were already holding it, or whatever gold they hold. And that has been true consistently for all of the Basels, 1, 2, and the discussions on 3, and the parts of 3 that have been adopted. So that just means that if a bank has gold, like physical gold in its vault, that has no risk, and it counts positively on their risk weighting as a result, in terms of them having lower risk. What is it also says is not only that you can have this role, which has been there, which is a BIS noted role, but that you also can again have it as considered a liquid asset, which gives it an additional kind of shine, if you will. So without a major announcement on that, it would be possible that we start to see banks using their amounts of gold, or stockpiling more gold in their balance sheets, or in their SEC statements, or just even in their sort of shareholder communications, if it gets to be a large portion of their reserve portfolios over their liquid assets. I don't know, and it's actually something I should look into if there is an item for that in terms of what's considered liquid assets in the SEC formats. But it should be if it isn't because of this new ruling. So in terms of dollar gold, I do see it over 4,000 in a year's time. And I'd mentioned that in that 10-year piece on Prinsights, debtsubstack.com, and also in a lot of the pieces. We've been pretty much forecasting a 4,000 level into 2026 and a 5,000 level into 2027, not because those are nice round numbers, which they are, but just looking at, again, all of this momentum, the purchasing that's going to have to happen, the demand that's going to come into the gold space. And again, once banks are holding more gold or central banks are holding more gold, it really does create a cushion for even where market volatility, which always comes up in any asset, might push gold down. And that's kind of what we've been seeing. That was the point of that 10-year piece, is that, you don't see gold really reacting that much to volatility. I mean, you see some percentage movements down here and there, but for the most part, it stayed pretty constant. And so that's why I think we're going to continue to see it creeping up to these levels. Demand's not going to stop. All of these extra rules and conversations we've been having from state level to, continued purchasing by sovereigns, et cetera, to being a tier one liquid asset for banks as of July 1st. This is all going to move towards 4,000 level for gold into 2026, I should say, somewhere in the end 25, beginning 26 arena, and up to 5,000 the following year.
Nomi Prins notes that the current gold-to-silver ratio, hovering near 100, reflects the significant lagging behind silver in the ongoing precious metals bull market. Historically, silver tends to outperform gold during the later stages of such rallies. However, its strong industrial ties and relatively low investor attention have thus far limited its momentum. From a broader perspective, the silver-to-gold ratio has shown a recurring pattern. Steep declines in the ratio, marked by historical red zones on long-term charts, are often followed by sharp or extended rallies in silver. Although technical indicators such as the Monthly Relative Strength Index (RSI) suggest the ratio may not yet be deeply oversold, the current setup still presents a favorable risk-reward scenario for silver relative to gold. The ratio continues to hover near multi-decade lows, reinforcing the idea that silver remains undervalued in historical terms. Silver's price behavior relative to gold typically aligns with the broader market and macroeconomic forces. While occasional explosive moves in the silver-gold ratio have occurred, often misattributed to manipulation, they are more accurately seen as responses to shifting macroeconomic conditions. These include concerns about inflation, changes in monetary policy, and a shift in investor sentiment towards silver, particularly when gold has already made substantial gains. In this context, silver appears to be setting the stage for a potential catch-up phase. Let's get back to the interview.
One of the things that we've seen in gold, and it's a teeny bit back off of its highs, but it has registered, and I continue to write a lot about this, not just sort of standard old gold things as in, wealth accumulation and inflation fighting and all that in terms of an asset, but it's really become entrenched in conversations about some new form of a gold standard. Now, not necessarily the form that we had in before 1971, when we had the dollar attached to gold and you could redeem in gold and all of that. It's not so much that that's going to happen, particularly if there's a global element of a gold standard. There's just not simply enough gold to convert into everyone else's fiat currency as we move forward. But there is certainly a focus on using gold as an independent physical asset, which it is. And in terms of stockpiling it more and more so with respect to central banks that are keen to continue to diversify away from the US dollar. That includes, of course, China, India, the UAE, Saudi Arabia, and so forth. Countries that have been accumulating gold continue to accumulate gold as that diversifier against the US dollar, and also continuing to develop systems, payment systems. And we talked a little bit about this last time, to utilize potentially with that metric of an evaluation of gold in the backdrop. So even though this isn't an official gold standard moment, it is certainly what we're watching is a developing story where gold is taking on more and more of a geopolitical and geoeconomic than it has ever before. And I think this is going to continue. And the BRICS summit, which has expanded, has expanded recently to include all of these extra countries, including, whether it's Iran, Egypt, the UAE, Saudi Arabia, and so forth, which are oil producing countries and which have developed portfolios again into real assets as well, outside of oil. This is something to watch. I don't think the U.S. is going to reset everything with gold and silver. I mean, if anything, yes, that this could be a hedge where we're not about to go back to a U.S. gold standard, not least because we have nearly $37 trillion of debt outstanding, and that's not going to be repaid in gold. So, I mean, there's a lot going on, and a lot of different pieces to that. But I do think that there is some thought in the administration and the Treasury Department that if there are these other factors or other forms of currency, whether it be gold or whether it be digital, it can sort of diffuse that fiat nature of the dollar, not necessarily protect it, but just kind of diffuse the impact if it does get lower in price, that there is another form of asset in the form physically of gold or digitally in terms of Bitcoin or another form of cryptocurrency, probably Bitcoin as it's most prevalent, to pay for things or to be used in potentially the Treasury ledger to pay for things. So it's not necessarily to cut down on debt, but it might be to allow for less issuance of debt. But the numbers are still such that the debt's going to increase with this budget once it does get passed, certainly because of tax reductions that it has incorporated in it, regardless of what the arguments are that kind of finesse those around the edge. For growth of the Defense Department and other things is pretty similar. That's going to be a call on debt, and other nations aren't buying our debt to the extent that they were. So there's a need to have the Fed actually buy more debt, which he didn't specify, Trump, the other day, but reducing rates is one way of hoping that the 10-year and the 30-year will come down in yield. The 10-year has gone up in yield, even though rates have come down. And of course, rates haven't come down recently, but even so, it didn't come down the way their expectations would have indicated. In fact, the yield curve steepened, but not because things are better, but because things are worse, and because the 10-year is actually showing signs of worry, signs of stress, signs of debt anxiety, and a lack of as many buyers, uncertainty about the future. And so what gold is seeing on the flip side of that is that it can be sort of the savior for that. If you just looked at them as like potentially personalities, the 10-year personality, which is all sort of worried and fearful of the future, and gold as sort of the hero personality, where it's saying, look, I got this. And that's really what investors are showing by buying gold. And that's in addition to what we we're just talking about in terms of central banks diversifying with gold. Gold also has this role of being that not just historic safe haven because it's physical, which it also is, but also because it's now shown itself to be stable, even though the 10-year and of course the 30-year is just touched above 5%. It's a bit below it as we speak now, but it's shown itself to be more of the stable form of non-debt currency.
As instability continues to ripple through the financial system, precious metals are reclaiming center stage, not just as safe haven assets, but as strategic hedges against policy uncertainty and weakening currency trust. While gold remains the primary focus due to its historical monetary significance, silver's often overlooked strength and industrial relevance are now catching the attention of investors. The widening gap between the two metals has created a compelling value opportunity, particularly as underlying fundamentals suggest a potential realignment. With volatility surging and long-term dynamics shifting, the traditional roles of these assets may be poised for a dramatic reset. Could silver's delayed reaction be setting the stage for a powerful resurgence, signaling a turning point in how investors value industrial versus monetary assets? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.